Our next speaker, and I'm going to introduce Kevin Cawley. Kevin is the National Account Representative for CSSI. CSSI is a Cost Segregation Services, LLC. Kevin has been the National Account Representative for CSSI since 2015. Previously, he spent 11 years in the construction management industry, advising builders on how to safely and properly construct all types of commercial property. During this time, Kevin learned how important cash flow was to every business owner he encountered. He also learned that relationships are key in business, and if you can develop a good rapport with your team and clientele, then the work can flourish on future projects. This vast experience was a perfect fit when he came to CSSI. It parallels perfectly with building owners. Working through details of cost segregation with clients not only requires specialized knowledge, but also requires great attention to detail and strong communication skills, which I know Kevin has great communication skills. In fact, some of Kevin's clients from his past career are still some of his clients with CSSI. Kevin currently resides in Downers Grove, Illinois, with his wife, Lauren, and two daughters. In his spare time, he enjoys taking boat rides with family, fishing, golfing. Kevin also plays the guitar and piano and still meets with his brother weekly to jam. So Kevin, hey, welcome to the stage. I learned more about you just now than I knew, and we've
Right?
known each other a couple of years now. So
Yep.
good to see you this morning, though. I'm going to just turn the stage over to you for
Sure.
the next 40 minutes or so, and I'll come back and we'll do some Q&A.
Yeah. And I just wanted to say, I don't think Bill's on anymore, but he did a great job. Bill Withers there, the last speaker.
Yeah.
I'm going to definitely reach out to him after this. I was impressed, to say the least. So kudos to Bill if you're on. If not, I'll reach out to you.
Awesome.
So can you hear me well, Mike?
Yeah.
Cool. I'm going to share the screen for those of you who are going to be on here. I keep it short and sweet. What I'm going to do is show everyone here, and you probably know this already, what happens when you buy an investment property. Automatically, you go on straight line depreciation. So there may be a couple people on here who don't understand that. So we're going to go over that first, super simple. Then I'm going to show you an example of, hey, here's a guy who was doing straight line. We offered this allocation of 5, 7, 15-year assets through cost segregation. Here's his depreciation now. So it's going to be short and sweet, but there'll be a lot of time for Q&A. So I'm going to hit my share screen. Okay, bear with me. And let's make sure we can see. This is an actual client. Does everyone, can you see the screen, Mike? It just says CSSI. It's like an example.
Yes, we do.
Cool. Very cool. Okay. So like I was saying, I had a client who bought a property in May of 2022 for 1.755. If he didn't know me, automatically what would happen here, and I'll blow this up, is his accountant is going to take the purchase price, 1,755,250. Land does not depreciate. So this is the purchase price net of land. Purchase price was probably 20% higher than that. But what the accountant's going to do is he takes the purchase price, residential assets, and I know we're focusing on residential assets, depreciate over 27 and a half years. You can see here. Commercial assets depreciate over 39 years. So anytime someone buys an investment property, their accountant goes, hey, you need a depreciation schedule. The IRS goes, hey, you need a depreciation schedule. Well, what do? They're going to take the purchase price divided by the asset class. So in this case, 1,755 divided by 27 and a half. What we like to show here is my client's depreciation from year 1 to year 27 and a half. Every year you can see it's going to be the same number over and over and over. What does that mean? Depreciation offsets taxable income. So every year, just for owning this investment property, whether he does cost seg or not, he's going to be able to reduce his taxable income by $63,821. Okay. Why cost seg exists? Came out in 1997. There was a huge lawsuit with the Hospital Corporation of America versus the IRS, or the IRS versus the Hospital Corporation of America, because Every 5 years, they were replacing carpeting in the hospitals. Every 15 years, they were repaving their parking lots. Every 7 years, they're replacing ceiling tiles, acoustical ceiling tiles, etc. The IRS said, you can't do that. Well, they brought receipts to kind of show, hey, this is what we've been doing each and every year. And so the IRS said, we got to come out with some protocols and processes so that the common investor could do this. So those protocols and processes we still use today. And all it is basically segregating assets. We take a building apart on paper, put it that way, right? So instead of just taking all the parts, pieces, components that make the building what it is, dividing it by 27.5, we tell our clients, wait a minute. We're going to assume 20.3% in this example. So every building's different too. We actually do look at these. It's not just a paper-based thing, or we actually check out the properties, but 20.3% of this asset, we said, could fit in this 5-year category, right? And then we said there'd be no 7-year property. Okay, 7-year property is usually FF&E, furnitures, fixtures, equipment. And we're saying 0.4% of this client's assets could fit in 15-year property, right? So if we take these allocations, again, this is an estimate. My client Joe became a client, but we said instead of the 63,821 over and over and over, if we do those allocations, his depreciation now, let me get rid of this, sorry. Now, instead of being the 63,000, would be 355,078 and 78 bucks, which would be, if you do the math, 663 or 60K goes into 355. How many times? 6, 12, 18, 24, 30. Call it 5 years, almost 6 years of straight line depreciation. We're going to roll into a ball and give it to him today. My client was also in the highest federal tax bracket, 37%. So this is a federal service. I get asked quite often, does it do anything with the state taxes? Yes, because we're reducing my client's income by 355. So when you reduce income, taxable income, it's going to reduce the state tax too, but it's a heavy federal service. So we do the depreciation expense. It's calculated just like a write-off, 355K times 37%. And what that did was help my client reduce his income tax liability by $131,000. And for this study, we charged $6,500. I'm going to pause there, just to take everyone's temperature, so to speak. There's some other things I want to say, but I think it's a good spot to take a break, or at least ask if they have questions, because, Mike, I've done this with you before. It's pretty straightforward stuff that I dive into as far as the example goes. But then, as you know, there's a lot more deeper questions where we could get into the weeds. So I'll stop there and let's see if we got any questions. It froze. Everyone's on mute. Hello. Can you hear me?
Yes, we can. I think some people are a little bit shy in asking questions.
Oh, that's okay. Oh, no, that's more than fine. Honest to God, I was just like, no joke in my head. I said, oh, crap. Like my internet cut out or something. So Mike was adamant to make sure all my stuff works. I was here a half hour early, running around. Let's see on what size property should you recommend doing it? So my firm will work on any properties, investment properties, any asset class, single family, self-storage, multifamily, apartments, hotels, retail, restaurants, etc., with a minimum basis of $150,000. That is very unique. Most firms have $1 million benchmark. So our firm will go that low. Of course, kind of the bigger, the better. Really what matters with cost seg is I do a lot in the self-storage space, but think of it. It's just a big warehouse full of mini warehouses. So multifamily gets a much larger benefit because there's more guts, right? So the more parts and pieces there are to look at and see if they qualify for accelerated depreciation, the better. The lower the benefit. But yeah, our minimum is 150,000 in basis, which means you could buy a house for 75K, and if you put 75K in improvements, you would qualify for us to at least run an analysis, no problem. And Rain, thanks for jumping in there. I was nervous for a minute.
No worries. I'm always here for you guys.
Yeah, thanks.
So, there is a question on our chat on the Facebook Live, from Cheryl. What size property are you analyzing here? I think that this is the one that you're showing right now. Is it
Yeah.
actual or a scenario?
So this is not for tax purposes, but this is a real deal I did. So this is actual. These are real numbers. We could get in the weeds on bonus depreciation. So any property acquired in September of 27 or September 17th of 2017, September 27th of 2017. There we go. All the way up to December 31st, 2022. So September 27th, 2017, anything acquired from that date to the end of 2022 gets 100% bonus depreciation. I'll explain what that is. Pre-bonus depreciation, all of the 5-year assets that we'd segregate out, and I'll actually go to some 5-year assets. So here's an example. Here's some 5-year assets, right? Cabinets, millwork, moldings, wood flooring, laminate flooring, security system, building signage, right? Pre the Tax Cuts Jobs Act that I just talked about, 5-year assets would depreciate over 5 years. So we're still accelerating their depreciation, but the benefit wouldn't be big upfront, like in that example I showed you. So 5-year assets would go over 5 years. 15-year assets like this, parking lot, sidewalk, curbs, would go over 15 years, get the depreciation over 15 years, as opposed to 27 and a half. What President Trump did with the Tax Cuts Jobs Act, he said anything with a 20-year useful life or less, you don't have to wait 15 years or 7 or 5. You're going to get all that upfront, 100%. Buildings acquired in 2023 get 80% bonus upfront. Buildings acquired in 2024 get 60% of bonus depreciation upfront. And lastly, buildings in 25 get 40%. The bill to bring back 100% bonus depreciation, which is my campaign, let you guys see that, passed the House already. So in November, they're voting. Hopefully it passes the Senate, but then properties retroactively acquired in 2023 backwards, we get 100% bonus all the way up till 2026. So it's kind of exciting times for us. People in my profession are kind of like on the edge of our seats, right? Because if they make it 100% bonus to 2026, it's going to be really good for anybody in real estate across the board. Can I cost segregate any properties from past years which I bought and missed on cost seg? The answer is yes. And if you guys bear with me, I'd love to pull up a study I did where the client acquired the property in 2006. So pretty cool. Let me just move this up. There we go. Okay. Invoice. Here we go. All right, so this is a property local to me here in Hinsdale, Illinois. There's the full report. We'll keep that open. Keep that out of the way. So that it's a good question. I wasn't prepared for it, but this is going to be an awesome answer. So, common misconception, most people think they can only do it on new properties. I hear it all the time when I get referred clients and they go, hey, yeah, but I thought you could only do it in the first 5 years. Not true. So here's a real example. Given it's not multifamily, sorry guys, but it's a restaurant downtown Hinsdale, Illinois. The client bought it in 2006. I was hired to do a cost seg study in 2023. And his normal depreciation, we could figure that out. But bottom line, at the end of the day, we were able to get him a depreciation expense of 191,000 multiplied by his federal tax rate, 37%. It's the highest federal tax rate out. we were able to net the client a $70,000, 988 income tax deferral or reduction. So we reduced our client's income tax on a property he's held since 2006 by 70 grand. We charged him $5,000 to do that. Is it worth 5 grand to keep 70 grand in your pocket? I would argue all day, every day. But yes, I think that would answer that question there. I see another one coming in. Does the cost seg analyst work hand in hand with the CPA, since some CPAs don't know about this strategy? The answer is a resounding yes. So I would say 90% of my firm's entire business comes from tax professionals, guys like Bill Withers and the like. And we work hand in hand with them. We work a lot on basis and land allocation issues with the client CPA. The beautiful thing is this is all my firm does. So we don't do tax returns. We don't want to do tax returns. So when we come in to talk with tax professionals, or let's say someone on the call today or on the video chat today wants me to discuss cost segregation with their CPA, it's a soft approach. Hey, this is all we do. We're not trying to take your client or his tax work. It's just a value add. That's all it is. These reports are heavily detailed. It takes my firm about 3 weeks to do a report start to finish. And accountants know they don't have the time to put in 3 weeks with other business practices. So we kind of say, hey, we're going to come in, we'll take on the liability. We've done close to 50,000 of these. We know what we're doing, and we're pretty expedient. Where 3 weeks, maybe people go, hey, it's 3 weeks, but our firm's trying to get it to 2. The average cost seg takes 4 to 6 weeks. So we're ahead of industry standard. Oh, we got another question. Are these reports done remotely or in person? All in-person visits. So there's 150 of me at the firm. We'll get someone out there. We don't do any virtual visits whatsoever. So 100% in person. That is recommended by the IRS. Are you going to go to jail if you get a cost seg done and the site visit was virtual? Probably not. But we like to do it to the letter of the law. And, if they say they want in person, we go in person. So 100% of our site visits are in person. There's no questions now. Mike, do you mind if I tell the crowd how good you got me the other day when you called and my CEO was in the car real quick?
You don't want to tell that story.
Oh, man. It was good.
I have some questions for you though.
Yeah, please.
That can you use a cost segregation study when you do a 1031?
So it used to be great when the Tax Cuts Jobs Act came out. Let me pull up this report and I'll hit share screen. Give me a sec. The answer is yes, but it's not as awesome as it was back before the Tax Cuts Jobs Act. It was great because what a cost seg does is takes real property, which is anything 39 if it's commercial or 27 and a half, and we change it to personal property, which is 5, 7, and 15-year assets. So what happened was before bonus depreciation, which we're still in the era of bonus depreciation, it's not 100%, it's 60% currently. But you were able to take personal property and roll it into the 1031, no issues, no questions asked, no big deal. Now that they give us bonus depreciation, all personal property, 5, 7, and 15-year assets will be recaptured, absolutely, at ordinary income tax rates. So you can only roll in your 39-year property. All of the cost seg work will be recaptured, meaning you got to pay it back at ordinary income tax rates. Usually what guys do is they go, oh crap, I didn't know that. I said, yeah, sorry, man. But they pay the bill, but then we'll cost seg the building they just traded into to offset that. So is it worth doing? That's to each their own, whether it's worth it or not. I'd say it would depend the size asset you're going to roll into. You'd have to do some arithmetic, right? You'd have to say, hey, what's the recapture look like? And then if we got to pay that back, what's the cost seg look like on the new one? And is that fiscally responsible? If you have investors.
So I
So
guess
is it
it
a
would,
yes, no, Mike? No. It's up to
okay,
you.
so
Sorry.
you'd have to look at it early on and decide, you know, and I always talk about exit plan, right? What's your exit plan on the deal before you ever
Yeah.
get to the closing table?
Right.
So you would actually have to look at it and say, hey, you know, I'm gonna do a 1031 exchange on the back
Mhm.
end. It might not make sense to do cost seg. It might just make sense to take straight line depreciation, right?
Yeah, yeah, absolutely. And I'm glad you brought it up that way. So my team, and I've been doing this 10 years, we don't push clients to do the cost seg or not. It's kind of like, hey, we're going to create this chess piece for you. You and your team can decide when and how to play it. And just like you said, sometimes it's probably better not to do the cost seg. If you got to weigh everything, like you said, and you got to have an exit plan. And if this could dovetail with the exit plan, great. But if not, you know, you got to do
Yeah.
what's best for you. Mm.
Right. So here's another question.
Yeah.
Will cost seg increase my risk of being audited?
No, I would say no. I would say no with my firm, and it's not a pat on the back or because I'm here, but there's a lot of mom and pop firms that pop up. We've been around since inception. So we literally say in our marketing, our studies have never triggered an audit. However, our clients have been audited and they do want to see what we've done. So the cause for the audit was never, hey, you did a cost tag. These things are done so often now. The IRS is very familiar with this stuff. And if you ever get called out because of a cost tag, it's maybe because someone's inflating numbers. And it's kind of like, hey, that's if you bought a $2 million building and I'm getting you $1 million of depreciation, there's something up, right? So it does not, I would say it does not increase your chances of being audited. If you're audited, they're going to want to see everything. I mean, they open up all your books. So my
Hey,
firm will go ahead. I'm sorry.
oh, no, that's right. Hey, we had a situation, we bought a property in Tampa, Florida. We closed on it in December of 2021.
Okay.
And after we closed on it, we did a cost seg and then did our taxes for 2021. And there was a huge depreciation because 2021, we were still at 100%.
Yes, sir.
And
Yep.
yeah, and so we did get audited in 2023, at
Mhm.
the beginning of 2023, and they you know we had to prove up where all this came from and data, and our cost seg company really wasn't helpful. We didn't use you guys. Um,
Sure.
and we our accountant though helped walk through it with the IRS. And you know, after about 8 months, it went away. We
Yeah.
got a letter that everything was fine. So, um,
Good.
you know, I think if you prove the fact, right, and you prove the fact that it's it's compliant, you're in good standing. So,
Yes, I would say that too. And then just so you know, our firm will, I went through my first audit in 10 years with a client last year. It was actually handled by email. And they said, hey, what's the detail on this? How'd you get this number? We literally screenshot it and emailed it back. And then a week later, they said, hey, you're good. But our firm will handle, you know how you had to get your accountant involved?
yeah,
We'll handle it 100% at no cost.
yeah.
So just as it, attains to the report, we're not going to look at anything else.
Yeah,
Um,
and I'm not going to throw anybody under the bus, but the company that we did use, we wouldn't go back to.
Yeah, well,
Because
hey,
they wouldn't, you know, they just wouldn't help us. So, which was
yeah,
kind
and
of
that's what I mean. So when you're dealing with the federal government, you want someone experienced. So I don't
right.
talk, I don't speak down about any competitor of ours as well. There's some great shops out there. It's usually the bigger ones who are nationwide who've been around, 20 plus years. It's a good sign, right? So the mom and pops may have they may be $1,000 less than us as far as a fee goes. At the end of the day, is it worth it if you got to go through all the crap you went through? Probably not,
Yeah. Hey, I know
Um,
one of the participants in the audience does ADUs, accessory dwelling units. You know what those are?
Pseudo familiar, but I guess what's the question? And then if I don't know,
Yeah.
I'll shoot
So
you
the
guys.
question is, and I know you kind of touched on, somebody asked, how small is a property to do? But, my question is, if somebody's building an ADU on a property, which is, another, apartment, so to say, is it,
Sure.
and is it worth doing a cost seg on that type of a structure?
Yeah, I would just say it depends on the size. So like, can you do it just on a unit that's within a building? No, unless it's like a commercial, rental. But but you could do it on the building and the ADU would get taken into consideration, I guess would
Yeah.
be my answer on that. I did want to show you guys one quick thing. I mean, first, does that answer the question you think, Mike, or no? If
Yeah,
not,
no, I think so. And Jennifer's asking also, if, can you do a single family home if it's valued at $1 million? And I think you could do a single family home if it's valued at 250, right?
yeah,
If
you nailed
you're,
it. Yes.
if you're going in and you're doing rehab and, working on a property, then, to do that would be, it just makes sense, right? Especially if you're spending money, you might as well take the depreciation up front, especially if you're flipping, right?
Yeah.
So,
Yeah. Well, with flipping too, I tell guys, I tell clients, I've had clients who told me flat out, hey, I'm going to do the cost seg, but I'm selling next year. And I'd say, why the hell would you do that? Because anything I just deferred for you, you're going to pay back right away. But guys are in unique spots and every story is different. This guy said, hey, I have to do it because I don't have the damn money to pay the IRS. So he did it, but we bought him a year, right, to figure it out. So he was really happy. I did want to show this real quick because there's not many questions, but just to show you guys the level of detail that this stuff's involved. The what I just explained,
Kevin, you got a lot going on that screen there.
I know, right? I know. It's all stuff pertinent, but there's one thing I just had here. It's called RS means. Give me a sec. I just want to show the level of detail this stuff is we get involved in. So here's what the engineers are looking at, just so you guys know. So when people go, oh, my accountant does it. No, he doesn't. And here's exactly why. This is real detail from a big group I work with out of Texas. Wood shelving, plywood with lumber edge 3/4 thick, 1 foot wide. Right? You see this level of detail? There's pages of this stuff. So I want to address just a quick thing because I hear it all the time. Well, my CPA is doing it for me. Do you think he's doing this? There's no way. So I just like pointing that out anytime I have an audience. This is from a walkthrough, and this is the level of detail we get into. So Mike, back to your audit question too. They said, well, how'd you get this number? Look at what we send them. We send them stuff like this. And their eyes almost pop out of their head. Here's where it's from, Mr. IRS guy. And they go, I don't know what half this crap means. You're good.
So yeah, it's a detailed breakdown, right? It becomes an engineering study of each component
This is what it is. Yeah,
of the asset.
this is real. Yeah, look at aluminum gutter, stock units, plain 5-inch box, 0.032 inches thick. I mean, it's wild. So I just wanted to get that out there because it's highly technical work. To understand the concept's pretty simple. We're taking things off a 27.5-year schedule, putting it on a 5, 7, or 15. And now by doing that, you accelerated the depreciation. It's that simple to understand. But here's the nitty gritty. So I just want to show the viewers this.
Awesome. So let's talk about bonus depreciation. I asked Billy the same question, but what's your opinion about bonus depreciation? Is it going to come back? What's the government going to do around that? And, kind of a second part to that question is, how does bonus depreciation really help, in this cost segregation right now?
Sure.
Yeah.
I mean, we'll answer the first one first. The government's the government, right? So the bill to bring back bonus depreciation at 100% passed the House. It goes into the Senate in November. My opinion and what our tax guys think, who actually go to the Ways and Means Committees meetings and stuff, say, hey, it's gonna pass. And they're saying that because, and again, I wouldn't take anyone's word for this stuff. The government, it can make perfect sense to pass it. It probably means they won't pass it, to be honest. If it didn't make much sense to pass it, they'd probably pass it. But their take on it is, the House and Senate, it's not made of paupers, so to speak, right? These are wealthy people. They all have real estate in some facet in their portfolios. So the resounding feeling is it'll pass. But again, Billy, I think, is who asked the question. I wouldn't count on anybody. We kind of got to wait and see what happens. So don't take my word for it. Don't take your buddy's word for it. You talk to another costing group or CPA. I wouldn't take anyone's word for it. We can't predict the future. That's simple. But how does bonus help? I mean, look at this example here. What would happen here is, since this guy got all the 5 and 15-year assets up front, his depreciation was 355,078. If it wasn't bonus, he would get this benefit broken out over the next 5 years. So it'd be a 5-year benefit. So what's 355 divided by 5? Tell you. 355 divided by 5. Instead of getting 355 up front, he'd get 71,000 a year in accelerated depreciation over the next 5 years. So how does bonus help? Bam, you get it up front, time value of money. Money today is worth more than money down the line. So if you could keep this in your pocket, right, or keep this in your pocket, as opposed to giving to the federal government, which I don't care if you're left, right, center, they're going to set it on fire or flush it down the toilet. They're just the worst stewards of money of all time. And you could keep this, put towards principal, pay down debt, maybe buy another property, cost seg it again. Just keep kind of that machine rolling. It's incredibly powerful. So, if I do the math here, bonus, he got all 5 years of depreciation up front, 71K times 37%. We would have saved him $26,000 a year for the next 5 years, right? So that's why bonus is powerful, right?
Right.
We're taking 5 years.
That's at 6. Is that
Yeah.
at 60%?
This example is at 100%.
Okay.
But even when we run one at 60, like Mike, I know we ran one for you previously.
Yeah.
This number we're showing is at 60% and this is at 60 already. So you on your end, you don't have to do any calculations. We're showing you we do the math for you, put it that way. Just so you know. Yeah.
Awesome.
And I could pull up a 60, I don't know how much time you got me for, but I could pull up a 60% one and
we got a little bit more, but here's another question. How does cost segregation affect my passive income and passive loss limitations?
Yeah. So I saw Bill talk. So here, I'm going to answer in 2 ways. So passive loss limitation. If you're not a real estate professional, okay. I know, Mike, you asked Bill this question. He didn't touch on it, but I will. You're not a real estate pro, but I'm an investor in your deal, Mike, right? I'm an LP. I'm not a real estate professional. Okay. You're going to do cost seg anyway. What I'm due as far as depreciation, since I'm not a real estate pro, let's just say I'm owed 20% of this, right? The passive limitations, I forget how high it is. I wish Bill was on. He could probably tell us. I could probably Google it real fast, but I forget or who asked the question? Let's ask them. Do you know the limit of passive?
I'm asking the question.
Oh, shit. Okay. Yeah, that's fine. Yeah. So here, put it this way. To touch on this, okay? I'm due 20% of this. I'm not a real estate pro, just a passive LP. 20% of this, I can't take it all up front because I'm not a real estate pro. I'm going to take whatever the limit is, Mike. Whatever the limit is, I'll be honest, I don't know what the limit is. But then anything else that I can't take because I've reached my offsetting the passive income gets suspended. Okay. What's cool, kind of cool, and I've had clients want to do cost seg even though they're not real estate pros because of this, is the rest of the benefit that I'm owed gets suspended. When you sell the property, it gets released to go against cap gains. So you, as a real estate pro, get the benefit up front to offset taxable income. A passive LP who's not a real estate pro would get the benefit on the back end to offset capital gains. But no matter what, You're getting the full benefit. Just real estate pros get to take it out front to offset the now. And the passive LPs can offset it later. So I don't know if I helped or made it worse, but that was my answer there.
Yeah. Okay. Tyler's asking, are there any pitfalls to where it
Yeah.
would make sense not to do cost segregation?
Great answer, or great question, sorry. But here's the answer. At the end of the day, it always comes down to recapture, right? So whether you do cost seg or not, no matter what, 100% of the time, there's recapture on depreciation. So let's say my client doesn't do cost seg, but he owns the building. I don't know however many years this is. 1, 2, 3, 4, 5, 6 years. When he sells, again, he didn't do cost seg. When he sells, 63,821 times 6 will be recaptured. You got to pay it back to the government. So there's always depreciation recapture 100% of the time. Just our recapture 5, 7, 15-year assets is paid back at 37%. It's paid back at your federal income tax bracket. So it's paid back at your ordinary income tax rates. So when do you not do it? If you're going to if this was your building and I got this benefit for you today, and you're going to turn around and sell the building next year, you're going to have to pay this back. The one thing you pay it back. So is that a good financial decision? Probably not. The point of cost seg is to take the tax savings, right? Reinvest it because there's going to be a doomsday when you sell, unless you're a legacy holder. You're going to hold forever. That's awesome. But usually people get into real estate to buy, stabilize assets, hold them for a couple of years and sell for a multiple. So the question would be here, if you got time, the pitfall is this: depreciation recapture is real. It's going to happen anytime you sell the asset. So the pitfall would be created by yourself. If you're going to flip an asset, maybe don't do cost seg. I tell clients you want to hold a minimum 3 years after doing a cost seg, because if you saved 130K in taxes, that gives you 3 years to make a nice percentage on that, right? Some interest on it or something, so that when you do have to pay it back, you made some profit off it, right? You're not too worried about it. So 5 years is even better. So the longer you hold, the better it is. If you're gonna sell a property in the first 3 years after doing cost seg, I don't think it would be worth it unless you have an awesome investment where you can make some good dough on it. And now I keep highlighting this number, guys. The number could be 50K, it could be whatever it is. I just highlight this because it's the example we have in front of us.
Which is a great reason. So, everybody here syndicates multifamily. Okay. So
Right.
if you're syndicating multifamily, you're raising capital and your LP says, well, why are we not refinancing before 5 years? Or why are we holding it 7 years? A great reason is because we want to eliminate or lessen the clawback that the IRS is going to do on any of the cost segregation depreciation. So,
Yeah,
a lot of
absolutely.
times it becomes, how do we help, maybe twist the story a little bit so that it's favorable for why we're doing something.
Right.
Makes sense.
No, you nailed it. And that's why a lot of funds I work with, they have a 5 to 7 year hold period and then they get out. So, yeah, really good question.
So, if you want to tell the story, go ahead.
Wait, the story of,
When I got you the other day, so good.
oh yeah, if you guys don't, this is awesome. And then we'll stop.
Hey, you guys, you have to understand though, I have a very sick sense of humor. I'm very dry and so Kevin will tell you this story.
Yeah, and good timing. My computer's saying my connection's unstable. But listen to this. I pick up our new CEO. We're private equity backed. We got bought about 8 months ago. The new CEO flies in. He wants to meet some of the top guys. So I pick him up from the airport. We go to get coffee. We park. We're downtown. I get a call from Mike, and I said, picked up. Hey, Mike, I'm in the car with my CEO. So don't say anything vulgar. I'm just joking with him. He goes, hey, yeah, that's fine. But what happened the other day? I mean, what do you mean? He goes, you totally screwed us. What the heck happened the other day? And I was like, oh my gosh, take me off speaker. I don't want to say what I have to in front of your CEO. I don't want to embarrass you. At this point, I'm turning red in the face. I'm going, what are you talking about? And then he just starts laughing. I mean, my CEO looked at me too, like, what the hell did you do to this guy? And Mike just starts laughing. He totally got me. And it was very embarrassing. And Mike, I thought you were dead serious because I was crapping my pants. I'm going, was the summit yesterday and I blew them off or something? That's literally what I thought. That's what I
Was
thought.
did that help you bond a little bit more with your
It
CEO?
did. It did. Yeah. Yeah. And he goes, how long has he been a client? I said, I've worked with him recently a couple of times, in the past 2 years. And I know you used us previous too, but yeah, it was a great, it humanized my CEO, right? He started laughing and he brought it up 3 times. We had dinner. I got home at 10 o'clock. At dinner, he goes, man, that guy got you, man. And I was like, I know. 3 other
That was
times he brought it up.
that was perfect. That was perfect.
It,
Hey,
it was
let me
very
ask
well.
a question. So I know
Sure.
you talked about older properties. So how far back can you go and do a cost seg
So what
on a property?
So what I tell guys, it's just like that example I had up with the restaurant, right? I tell
Yep.
guys, hey, I didn't know if there's going to be any meat on the bone on this thing, right? I had no idea. So I said, hey, it's free to run the numbers. Why don't you let me run the numbers and I'll show you guys this is an estimate. This is how it looks. It's not the final report or anything, but it's an estimate. And if the numbers look good, you show it to your accountant. If he approves it, let's do it. So that's what I always say. There's no date. I mean, that guy bought in 06. We're in 2024, although I was hired in 23 for what is that? 17 years.
Yeah.
We went back that far and there was meat on the bone. Now, if his asset, let's say his asset, this isn't what I wanted. Let's say his basis was 300K on an asset. Now, is it worth it to go back 17 years? I'm sure the numbers would show it's likely not, but let's look at it, right? There's no harm in looking. It's no sweat off the prospective client's back. It's all on me. So I'll spend the time and have a look. No issue. And I was going to show you guys.
So here's what I would say, most people on the call are in real estate, have single family assets, have
Sure.
small multifamily, large multifamily deals. If you have a deal out there that you think you can go back and you plan to hold it for a few more years, call Kevin and go back and at least have the conversation on if it makes sense to do cost seg. Because
Yeah.
if you can put a few more dollars in your pocket, I always say to people, I say, there's 3 things we want to accomplish: cash flow, long-term generational wealth, and what are the tax planning strategies? And if
Mm.
we can do those for our investors or for the investment and put more cash in our pocket, then it makes sense to do that.
Sure, sure. And what I'm showing you guys too here is my little sub site. It's not our official website. I could show you guys that too, but this is like a landing page to say, hey, good point Mike just made. I bought a building in 2010, right? 2010 for 300K. Let's see if it's worth it. You could just go to costsegkev.com. And I'm sure, Mike, you're going to share our info and all that.
Yeah, Rain's put it in the chat, but everybody will have it.
Okay, cool. Well, yeah, if you go here, this is so simple. Check it out. Bam. Right. This is not like filling out an insurance form. Name, email, what'd you pay for it? When'd you buy it? What kind of asset is it? And then get your quote. And that's it. We do it. And there you go. There's also an awesome FAQ here too. Common misconceptions, grow your business, financial benefit, etc. But it's a nice little site. It's one pager. Everything comes direct to me. I get a constant alerts on that, which is good. So I won't skip over you or I never get too busy, which is a good thing too. We have a robust team. And then not only that, what I love to tell guys, I have a lot of people who actually call me or find me on Google. They say, oh, it's Kevin. And they go, it's actually you. I said, yeah, what do you expect? I don't know, an assistant or something. No. So call, text me anytime. I'm here to help. All I want to do is be a resource. And I will always shoot you straight. And so
Hey, are there other asset classes that you can do cost seg studies on?
So it's literally any investment asset. I've done golf courses, marinas, hotels, you name it. Honest to God, you name it. Gun ranges, things like that. Mobile home parks, airports, You know, it's got to be a taxable entity, right? So no nonprofit stuff and no municipalities because
What about
government's.
precious metals or gas and oil?
You know, that's a good one. I personally never have, but I don't see how unless the land has all these hookups, like a golf course, right? It's all grass but under the ground they have all these hookups for the water, electricity, things like that. Personally, I don't know. I'll shoot an email out just out of curiosity and say, hey, have we ever done any oil and gas or precious metals? But to my knowledge, no, but it doesn't mean it's a no.
Right, right.
Yeah.
Rain, Jennifer's asking for the link to the landing page. Can you post that in the chat so everybody can grab that? To
Yeah.
catch Kevin. Well, Kevin, any last insights or anything you want to leave investors with this morning?
Can you hear me well? It got
Yeah,
choppy
no,
there. Can
you're
you hear
good.
me?
Yeah, you're good.
Yeah, no. Any last insights? Personally, no. I'm sure once we hang up, I'm gonna go, crap, I should have mentioned that. But I really appreciate you having me, Mike. Thanks for letting me tell everyone that joke. That was phenomenal. And uh I'll put my stuff in the chat too for you
We
guys.
got jokes though,
So,
that's for sure. So
yeah. And then I'll probably hang out for a little bit too. I'm just gonna take the video off.
yeah, no, absolutely hang around because the next panel coming up is going to be on capital raising, and then we have a
Sweet.
lot of good speakers this afternoon. So definitely hang around for sure. You're more than welcome. So
Okay, cool.
glad to see
Yeah.
you. Thanks for being here.